that precise moment is at that point that most people tend to go into cruise control mode, right? They think to themselves, we've already done negotiations. We've already gotten conditional loan approval. Like, we're good to go. We don't need to worry about anything else. And they kind of take their foot off the gas. They coast into cruise control mode. And that's when they are starting to make the biggest mistakes. And that leads me to my next point, which is that you should never, ever Welcome to the Home Goals Podcast, the ultimate guide for turning your home goals into a reality. I'm your host, Derek Thornton. Join us as we navigate the twists and turns of obtaining a home. We'll be offering expert tips, helping you avoid pitfalls, and championing your journey towards that cherished place to call home. In this week's episode, we are going to discuss some horror stories revolving around financing. Whether people realize it or not, financing issues, mortgage issues, lending application issues, those are the number one reasons that deals fall apart, right? When you factor in all the variables, all the different things that go into buying a home, whether it's repairs or the actual condition of the home, any of those different things that can happen, the buyers, the sellers, whatever they're going on in their personal situations, all the variables that come together to make one deal happen, the number one reason it all falls apart is because of issues revolving around financing. So it's incredibly important. It's crucial for you to understand why these things happen and what you can do to avoid them. And so I've got some stories of past deals that have failed as a result of financing issues. And more importantly, I also have some tips or things to keep in mind whenever you're going through the process to make sure that you don't end up in that same situation. So we're going to go into the 7 things not to do when you're applying for a mortgage loan or going through the process of purchasing a home. And I'm going to go into detail with each of these things, explain why it's an issue, why some people may be confused about why it's an issue to begin with, and how you can make sure that this doesn't even come up, right? Most of the deals that I have, these are never an issue. These problems never even take place because I always make a point to do a really good job of walking people through all the things to do and not to do when you're applying for a loan so that we never even have to entertain or come up with these horror stories. And so I'm going to walk you through a lot of the things, a lot of the advice that I've gotten from lenders and mortgage consultants that I've worked with over the years to make sure that you are in the best position possible whenever you're ready to make that purchase, right? And so when you first go through the process of purchasing a home, you initially have to go under contract first, right? So you have to submit the offer, get the seller to accept it, and once they do, then you're officially under contract, and that's when the real work begins. That's the part that they don't really show you on HGTV, right? This is the part where you're really getting into the nitty-gritty of submitting all the documents for financing, going through the inspections, appraisals, all the other things that no one really likes to deal with. That's when you're going through that process, right? And so in the state of North Carolina, we have what's called a due diligence period. And this is your time to really investigate and figure out what's going on with the home and if there's anything that will cause you to want to back out of the deal. Now, in order to get to that actual part of the process, there's usually a upfront fee that you have to pay to get that home under contract to make sure that no other buyers can come in on that home. We have a due diligence fee that gives you the right to have that time. If the deal closes successfully, that due diligence fee is refunded back to you. But if you back out for any reason whatsoever, you lose those funds. You also lose any funds that you've spent on inspections, appraisals, survey, any of those things that you may have paid for during that time period. You lose those funds if you decide to back out. But there is still a feature in the contract that allows you as the buyer to step in at any point and terminate that deal and say, hey, I don't want to go through any further. I don't like what I saw. And so this due diligence period is kind of your time to figure out whether or not you actually want to go through with that sale. What often ends up happening is that once people get out of that initial due diligence period, there's usually another week or two afterwards where at that point you're essentially tying up loose ends. You're kind of crossing T's and dotting I's, kind of going through the final things to make sure that this deal It's all wrapped up and ready to go. Once you get to that point, it's not a certainty, but we're pretty sure that this deal is going to close. And it's at that precise moment, it's at that point that most people tend to go into cruise control mode, right? They think to themselves, we've already done negotiations. We've already gotten conditional loan approval. Like, we're good to go. We don't need to worry about anything else. And they kind of take their foot off the gas. They coast into cruise control mode, and that's when they are starting to make the biggest mistakes. When you're going through with the home purchase, you always need a healthy amount of fear, because if you have some level of fear in the deal, you're going to be paying close attention at every part of the process. You're not just going to sit back and think, okay, whatever happens, happens, and I'm good to go. You need to make sure that you are paying close attention at all stages of the process, not just during the due diligence period. And that leads me to my next point, which is that you should never, ever make assumptions, right? Never assume that you can do something in a deal or in a transaction and you know how things are going to turn out as a result of that action. You always need to check in with your realtor. You need to check in with your lender, the underwriter. You need to make sure that you're running all these things by them. Don't ever assume based off of what your friends or family may have said, based on what Google may have told you. Don't do anything, right? You need to make sure that you have definitive proof from the people that matter, right? The people that are making the decision. I don't need to go to someone who may have done a deal a few years ago and see what they did. No, you need to go to the people who are making the decision in your transaction and make sure that you get word or say so from them before you go through and make any changes or decisions that could have a negative impact on that deal, on that transaction, right? And so always keep that in mind, is that when you're tempted to go into that cruise control mode and think to yourself, I don't really need to go through the process of changing these things, or I can kind of take my foot off the gas a little bit. That's the moment where you really need to be most careful in making sure that you don't do anything that jeopardizes that deal. And so the 7 things that we're going to talk about that you should not do when you're going through the process of applying for a mortgage loan. Number 1, don't change your job. Now, usually this goes without saying, right? People will think to themselves, oh, that's more so referencing people who quit their job or something like that, right? We're thinking like, oh, like you don't need to worry about that if that's the case. Again, it's not always just a matter of quitting the job to go in, but it's also a matter of whatever job you're going to, because again, the loan process, they're verifying things based on your current position and your current role in the job that you have. If you change that job, they have to restart that entire process all over again. And so we have a lot of times where people will switch jobs, and in their mind, they're assuming because, oh, this new job, I'm making more money, it shouldn't be an issue, right? It shouldn't be a problem. That should be A-okay. No, that's going to restart the entire process all over again. And so a lot of times we may just tell you, hey, you may want to wait until after this deal is over to accept that role or to go into that new position, because again, it will have to restart the entire process. And there have been certain times where I've had clients who had a job that paid better and they got that new option, but the mortgage underwriter was requiring that they needed at least a month's worth of pay stubs for that new job, which meant that the deal now has to be delayed an entire month in order for them to make sure that they qualify for that loan. Sometimes it works. I've had deals where that worked and the seller was willing to grant that extension. I've had deals where that didn't work and the seller said, absolutely no way. We're not going to sell this house to you anymore. We're going to go look for another buyer who has their stuff together, and the person lost out on that home. And so again, do everything possible to avoid changing a home. I had a deal several years ago. I think this was in my second year of real estate, where a teacher who was in New York, who was purchasing my client's home, they were buying out here and they needed that sale to happen out there. And she switched schools. Right. So she changed jobs, changed to a new one mid-transaction. And because she did that, again, the underwriter had to go through the process of restarting the entire process all over again, because they were like, we need to verify that you're actually making that income at this new job. We had a lot of things that we had to check on, and we can't just approve this loan to move forward. That meant that they had to extend the deal. My clients couldn't afford to do that because they had a deal out here that hinged on that timeline working out. They couldn't get the timeline to work out here, and so it had a domino effect and killed the transaction out there as well as the transaction out here for my clients too. And so it had a ripple effect of that one decision of them changing a job caused two different transactions to fall apart, and they didn't get the house out there as well. And so always check with the lender, the mortgage underwriter, if you're even considering changing your job in the midst of a real estate deal happening or going on. 2, don't change banks or move money around. They are going to ask for your bank statements, all of your accounts. They want to see the bank statements. They want to see the money coming in, the money going out. They're more focused on the money coming in, right? They want to see a paper trail of where that money is coming from. They don't want it to be a situation where you make it appear that you have more money coming in than you typically would have, right? And so if they see you start moving money around or bringing in funds from different accounts, they're going to want to see those statements from those other accounts as well. And sometimes you may not be willing to or may not want to. You may be accused of kind of playing a shell game with your funds. You don't want to bring up any of those red flags. And so avoid changing banks or trying to move money around from other accounts. They're going to be going through every single part of your financial situation. Trust me, you will not be able to hide anything from them. And even if you try to, I guarantee you they'll catch it or see a red flag somewhere in the process. 3, don't deposit cash. So again, this is a confusing one for some people because they're like, well, cash is king. Like, why would that be an issue? Cash always sends up red flags because, again, there's no way for them to trace where that money is coming from. Is that coming from another income source where you're technically getting paid underneath the table, but we can't count that towards your actual income? Where are these funds coming from? Because it looks as if you're trying to make it appear that you have more money coming in than you actually do. And so I always, my spidey sense starts tingling if I ever hear someone talk about they have a safe or they got some mattress money at home that they plan on using in the deal. Again, that's going to send off all the red flags to the lender because they're going to wonder, where is this money coming from? I had one deal where it was like someone had a bunch of cash that they wanted to use towards the transaction, but we had no way to trace or source where that money was coming from, and they couldn't use those funds in the deal, and it ended up impacting their eligibility for that loan, right? And so again, do not deposit large sums of cash, right? If you have a birthday, anniversary, or something like that that comes around where you maybe had an influx of cash from certain people as gifts, again, just give the lender a heads up and let them know where that money is coming from and they may tell you, hey, hold off on that. Don't really use that right now, but always check in with your mortgage consultant to make sure that's going to cause any issues. 4th up, don't make any major purchases. And really, I should tweak this or change this. Don't finance any major purchases, right? So if you have a huge amount of cash or influx in your account that's been in there that can be sourced and accounted for, and you want to make a large purchase, right? Let's say you want to buy a car or buy a large new piece of furniture or something like that. You have every right to do that. And as long, of course, as long as you have the funds to still buy the home, it should be completely fine. That's not a huge issue if you're paying cash for a large purchase. Where the issue comes in is when you try to finance a large purchase, because they have banks have something that they look to whenever someone's trying to buy a house. They are very focused on what's called your DTI, that's your debt to income ratio. They will look at however much money you make on average each month, and they will say, hey, we don't want your overall debt payments to exceed a certain percentage of your monthly income. So they look at all of your debt payments and they say, okay, what are your student loan payments? Do you have a car loan? Do you have personal loans, credit card loans? What are the monthly payments on each of those things? They're going to total all those up. And then they're also going to factor in what is going to be your new mortgage payment. And when they add all those numbers together, if it's over a certain percentage, you may or may not qualify for that loan. That's your debt to income ratio, right? So let's say, for example, they said, hey, based on the numbers, we don't want your overall debt payments every single month to exceed $3,000, right? And you look at the mortgage payment and you realize that your mortgage payment is going to be $1,800 a month. Well, then that means that you now have $1,200 to account for all of the other debt payments that are going on, right? So let's say you have a student loan payments that's $400 a month. Well, now that's $800 that you have left for other debt payments, right? Let's say you have a credit card that takes it down to $700, right? Let's say you factor in all of those miscellaneous debt payments that you have, and let's say when all is totaled together with your new mortgage payment, you have $200 left of your max debt to income ratio. Well, if you go out and you finance a new car that has a $400 payment every single month attached with it, you have now exceeded your max debt to income ratio, and you no longer qualify for that loan, right? And so that is why we always tell people to make sure that you don't finance any major purchases, because we don't want that to impact your debt to income ratio, but also it can even impact your credit score, right? And so I've had deals, and I have friends who are realtors who have had deals where someone will, again, they get to that cruise control phase of the process and they decide that they want to finance a new car. All right, they think to themselves, hey, everything's going good with this house deal. I can go ahead and get that new car I've been wanting to get. Or they might go to Rent-A-Center and say, hey, I want to get some new furniture for my new house. Let me finance this furniture. And they go in there and they make those purchases. And we've had times where the car purchase or the Rent-A-Center has either caused their credit score to plummet, or it has gone into issue where it caused their debt to income ratio to rise so high that they no longer qualified for that loan. You always have to make sure that those numbers check out. Again, I have horror stories and deals where a new car purchased right in that slim period of time after they've received loan approval and everything else has caused the deal to completely fall apart. And so you don't want to be in that process. So again, don't make or don't finance any major purchases while you're under contract. The next one we have is the fifth one: don't close credit card accounts. And again, there's some people trying to be proactive, and they may say to themselves, well, okay, I want to make sure that I close out these credit cards, or to close out these debts, because I want to help my situation look a little bit better. I'm just going to close out this credit card altogether because I'm not really using it. That can have a negative impact on your credit score, which in turn can impact your eligibility for the loan, the interest rate that you have. All of that can be impacted by the credit scores. The credit scores have algorithms that all revolve around your relationship to debt, right? The more debt you have, and the way that you pay it, how much it is, how high the ratio numbers are, all of that impacts your credit score, right? And so it's not just a matter of, oh, I don't have a lot of debt, so my score must be high. It's all in relation to what are you doing with the debt that you have, right? And so if you close out a credit account, that can have a negative impact. If you open a new account, that can have a negative impact. There was a story that went viral a few years ago of a girl in California gone under contract on a home, put down a non-refundable deposit, paid for inspections and surveys and appraisals and all those different things that you typically have to pay for when you go under contract on a house. And she had recently gone to Home Depot like a couple of months prior and was buying a can of paint, a little $9 can of paint that she got. And they were asking, hey, would you want to sign up for the Home Depot credit card? And she said, sure, I'll sign up for that, and charge the little can of paint, this little $9 can of paint, to her Home Depot card. It was such a small purchase. She forgot all about it. Time went on. That was dinging her credit score. And then ultimately, because it went into collections, it ended up plummeting her credit score, and she no longer qualified for that house that she had gone in to purchase, right? And so not only did she lose out on the house, but she also lost out on all the non-refundable fees and deposits that she paid up front. And so again, you need to make sure that you have all of those things checked out. If you're ever at a store or you're under contract and you're considering opening up a new line of credit or getting a new credit card or anything like that, do not do it. In the long term, it may have a positive impact on your credit score, but in the short term, it is always going to hurt your score if you're opening any new lines of credit, as well as closing any new lines of credit. That's always going to have a negative impact. Next up, don't apply for new credit of any kind. Like I said, that's the one where you don't want to open up new lines. You don't want to close old lines. You don't want to do anything that's going to impact that credit score. Again, it's always going to be impacted by what you're opening, what you're closing, and anything else. Now, there are some situations where I've had where a lender has told us that, hey, it's going to help them if they pay off this car, if they pay off this loan over here. That may put them in a better position to be able to purchase. But never, ever do that unless you get approval from the lender first that that's actually going to help your situation. Because you have no idea how the numbers may sway or change, and you don't want to try to make that prediction on your own. Number 7. And this is kind of the biggest catch-all to make sure that we don't have any problems in the whole ordeal or process. Don't fail to disclose information. Always make sure that you're upfront and you tell them everything that's on there. I personally, as an agent, I don't even like to know any of my clients' financial situation. I don't know my clients' credit scores. I don't ask about their income. I don't ask any of that. I tell them, you go into that lender's office, you put all your skeletons out on the table, they come out and tell me what you're good for, and I use that and I run with it. I don't ask any questions. I don't want to know about that one wild weekend of gambling that set you back several years ago. I don't want to know about your alimony payments, your child support. I don't want to know any of that stuff. I don't want to know about bankruptcy. I'll go tell the lender all of those things, and then they will tell me, hey, they're good to go, or hey, they got some things they need to work on, and I'll take it from there. But I would caution you to make sure that you tell that lender all the things that matter, especially if you're using like an online service or something like that as well. I've had situations in the past where someone went through an online service to get pre-approved, but they didn't share all the information, or the online service didn't ask all of the questions that it should have asked to make sure that they qualified, right? And they had a situation where they had a job that they hadn't worked at long enough for it to be able to qualify for this loan, and ended up having the deal fall apart, and they lost their due diligence fee. They lost the money that they had spent up to that point because they had not, or they had failed to disclose all the information, right? So when in doubt, disclose. And that leads me to my final concluding point: be a bother. Right? There's a lot of times where I hear people say, oh, well, I was going to call the agent, or I was going to call the lender, but I didn't really want to bother them. I just had a quick question. No, be a bother. If you have any questions whatsoever, always reach out to that lender and ask them. I would much rather you get on that lender's last nerve, bothering with question after question, than for you to just make the assumption that what you're about to do is okay, and then we're in a situation where you're not being able to close out on that deal. You always want to make sure that you're working with someone who knows how the deal works, how things are constructed in our area or in our local market, and can walk you through that process. But always don't be afraid to be a bother. Always ask the question first, and you're going to be in the best position possible. And so I hope that that's helpful for you guys. Again, I don't want to scare you, but I also want to make sure that you, have a healthy amount of fear when it comes to this process. And that is going to make sure that you are in the best possible position for success when it comes to making that home purchase. Have a wonderful day, and I'll talk to you all next week.